Hi, I'm Patu from Free FinCal, and many first-time Nifty Next 50 investors are finding out how volatile it can be, and they're wondering why is it so volatile. I have a feeling that they did not have a look at its past risk, and they just looked at the last couple of years' returns. And they looked at its star rating. I think just a few months ago, this fund was 5-star rated, and now it's 3-star rated. So when they did their research by themselves or looked at the recommendations from certain direct mutual fund investing portals, they did not dig deeper, and they're shocked to find out that. For example, for the last 2 years, from April 2017, this fund has essentially given them nothing. There's no returns. So why is it so volatile? There are two reasons for that. One is called the impact cost, and the second is the number of stocks in the portfolio. Now, impact cost essentially means that the price you get depending on how many shares you want to buy or sell in the market. So I have a detailed article on what is the impact cost, and I have shown that even if you take the top 100 stocks in the Nifty, the bottom few stocks have got huge impact cost. That is, it is very difficult for a fund manager to um, trade these stocks in large numbers, because unlike retail investors, the number of stocks that a fund manager should buy and sell is pretty large, and because of that there will be huge impact cost. That is, there will be a difference in price, and that is the reason why people say that lower the market, the free float market capitalization, higher the volatility of the stock, because if you try to sell or buy large amounts of that stock, of a mid cap stock or a small cap stock compared to a large cap stock, the price that you have to pay will be quite different from what you actually see in listed on the ticker. So there'll be a loss, and that loss is called the impact cost. And that is the reason why, if you notice, most fund managers will have HDFC Bank in their portfolio. HDFC Bank is one of the most liquid stocks. It's basically like holding cash in your portfolio. I mean, because a fund manager, for an open-ended fund, there will be inflows and outflows. So the fund manager has to adjust the fund allocation. So you'll just basically you can either alter the cash holding, or basically sell a few sell or buy a few of its liquid stocks, and HDFC Bank is one of them. Now, in the case of Nifty 50, it is a very small index. That is, the number of stocks is only 50. In the Sensex it is 30, and so on. But the impact cost of all those 30 stocks is quite less. That is, they are quite liquid. They are or 50 stocks is quite less. They are the most liquid stocks in the entire index. That is the reason why they are less volatile. They are the volatility is the lowest for the Nifty or the Sensex. Now, if you look at, so let's take a look at our usual rolling returns chart. And this is the 10-year returns. And if you notice, the green guy is the Nifty Next 50, and the Nifty Next 50 is the highest 10-year returns overall compared to the other indices that you see. The next index that you see, the white one, is the Nifty Small Cap 250. The Nifty Next 50 has comfortably bet this. Then there's a pink line. The pink line is the Nifty Mid Cap 50. Then there's a yellow line, that is Nifty 50, our good old Nifty 50, and the red line that you see is the Nifty Small Cap 50, and then there's a blue line somewhere in the middle, that's the Nifty Small Cap 100. So the number that you see there in the indices, that's the number of stocks. And this is kind of baffling that over the last 10 years, Nifty Next 50 has bet all these small cap and mid cap indices also, in addition to Nifty 50. Of course, if you look at that, you should not. This does not mean it has bet all these indices every year, or there's no risk involved. So this is a very misleading graph. You should look at the volatility and also the drawdowns. That is, how much it has fallen from its peak. I think it's probably here in the Nifty. That's probably okay. This is a very new index, so you don't see all these indices. You won't be able to see the what happened during 2008. You just have a look at what happened during 2008 crash for the Nifty Next 50. How much it fell. It would look just like a mid cap or a small cap index. What is more interesting and what I wish to essentially convey in this video is from the rolling returns. Sorry. Oh, sorry, the standard deviation, the rolling standard deviation chart. So what we are looking at is over the 10 years, we are looking at monthly returns and how much these monthly returns are fluctuated. Higher the line, more the fluctuations, more the volatility and more the risk. Notice that let's now compare, let's not don't look at Nifty Next 50, that's the green line, we'll come to that. Look at the top two lines. The top two lines here are the Nifty Small Cap 50 and the pink line is the Nifty Mid Cap 50. Those are the most volatile indices among those we have looked at today, and the reason for that is two things. One, their impact cost is high, their market capitalization is low, and of course the number of such stocks is actually low in the portfolio. Whereas if I add 250 small cap stocks, that's the white line. Notice how low the white line is. The white line is one of the most lowest here, and is actually in the past it has been comparable. It has got comparable risk to the Nifty 50 itself. So if I add 250 small cap stocks, the portfolio becomes diversified enough that the volatility becomes much lower compared to the Nifty small cap 50. And obviously the Nifty small cap 250 is less risky than the Nifty next 50 itself. And similarly, that is also true for Nifty small cap 100. It is lower, and then there will be that's it. So that's essentially it. So the what I wanted to say is that the Nifty Next 50 is so volatile because of two factors. One is that its impact cost is higher than Nifty 50, and the number of stocks it has got by constructions is actually lower. So if there is a Nifty Next 100, then that will be much less volatile than the Nifty Next 50 because I'm adding more of such stocks. That is the reason why the Nifty Mid Cap 150, I don't think the Mid Cap 150 is here. Let's not worry about it. I'll look at it later. That is the reason why the Nifty Small Cap 100 and the Small Cap 250, I forgot to add it. The Nifty Small Cap 100 and the Nifty Small Cap 250 have lower risk than the Nifty Next 50. That is because although the mid cap and small cap stocks will typically have higher impact costs, that is, it will be difficult to sell large amounts of them compared to the Nifty Next 50 stocks. But because the index has got enough number of such stocks, the diversification is higher and the risk gets lower. So the reason why the Nifty Next 50 is so risky is because of a combination of two negative factors. It has got high impact cost and it's the number of stocks in the portfolio is low, so that the effective risk becomes higher. I hope what I'm saying makes some sense. So you must be ready. I'm not saying exit your Nifty Next 50, but you must be mentally prepared to hold that kind of a fund. So basically holding Nifty Next 50 is like, if you look at this graph, it is like buying 100 small cap stocks in terms of risk. It is essentially like buying 100 small cap stocks, or maybe a little bit less risky than 50 mid cap stocks, something like that. So you must be ready. So you cannot say I have high risk appetite, I will hold large mid caps, large small caps, and then get scared of this. So you must understand this is the reality of the market. The so-called Nifty 100, the 100 stocks which are defined to be large cap, that is completely wrong. The bottom 10 or 15 stocks of that 100 will have considerably high impact costs. That is, they are much difficult to sell in large quantities compared to the top 10 or the top 15 stocks, and therefore it is wrong to classify the Nifty Next 50 as large cap. Anybody who does this is dumb. Please do not follow all these stupid classifications. Value research, this star rating is absolute nonsense. Whether it is Morningstar or Value Research, all star ratings are nonsense. They just they do not factor in other additional factors like the fact that the Nifty Next 50 is not essentially a large cap stock in terms of its impact cost. Classifying this as large cap is wrong. Yes, SEBI says so, but that doesn't mean they are right. Suddenly tomorrow, if the market picks up, this Nifty Next 50 will become 5-star, then everybody will start investing again in it, and then when the market falls down, then everybody will start cribbing. That is wrong. This kind of cyclic mistakes we should avoid, and we should understand the risks. So I hope what I wanted to say in this video is clear. Let me know if you have any questions. Thank you as always for listening. Bye bye.